Hello and welcome back to our YouTube channel. My name is Neil Kane. Today I'm going to be talking to you about a big concern of us that's happening really in the US and world monetary system that leads us to this video, which is called Own Assets or Get Left Behind. But before we really talk about this, we really have to dive into, well, what is money, right? What is money? Well, money is really, if we deeply think about it, is energy and work that you've essentially outputted, and you're receiving a token for that expended energy through what we call money, right? And that token allows you to now trade that work, that energy, for something else, whether it's a good, service, product, or you can take that token and then save that somewhere so you can use it later, right? And in this world we live in, the the system that creates these tokens are governments, right? Through central banks. Every country has a central bank that defines what one token is worth. In the United States, that's called the dollar, which then gets enforced as that legal tender and controls its supply, where the issue comes in. So when we talk about controlling the supply, when the number of these tokens grows faster than economic output, the value of each token falls, which means that your stored energy, if you store it, buys less future energy. So, if you travel a lot, I just went to India. I noticed, hey, 90 Indian rupees equal $1. How did that come to be? Well, I looked back just a year or two ago, 70 Indian rupees equaled $1. How does that happen? Well, it's likely happening because they're devaluing their currency pegged to the US dollar. However, the issue on our side of the world is we're devaluing our currency too. You look at our currency measured by the M2 money supply since 2008, we've seen a massive explosion and expansion, to our um, dollar system. We are printing out money into thin air, right? Three times the growth in the 17 years in terms of monetary expansion. Let's take a look since 1971, what's happened. In 1971, we decoupled the dollar from gold. The gold was there so that we would have a finite commodity, right, that we were pegged to essentially make our dollars worth something, right? However, when we depegged that, we essentially became a fiat currency. And the money supply since 2008 has expanded tremendously. So if we look in 2008, we had $7.5 trillion of dollars in circulation. In 2020, it was 15 trillion. And after 2020 to now, it's 22 trillion. Look at this graph. Look at the money supply. This is all the dollars. Now, this is showing you billions of dollars, but in thousands. So that means trillions. Look at those dollars just going up since 1970. It used to be fairly stable, and now it's just kind of gone up, and then it rocket ships up in 2020. Why? Well, during COVID, we pushed out a tremendous amount of stimulus into the system, right? We had to step in a lot of cases, preserve people's loans, preserve people's businesses, print out stimulus checks, lower the interest rate. All that costed money, and we upped our money supply by trillions of dollars during that time frame, which led to massive inflation. And in 22 and 23, if you notice, you see the little peak and you're kind of seeing it bend down. We had to take money out of circulation. Why? We had a massive inflation problem. However, look at that peak back up. It's rising back up again. What does that tell you? The money supply is expanding. So we're seeing more dollars being printed out since 24. And that's hurting all of us working. The productivity divide has gotten worse since the 1970s. $1 of compensation for your work is less than it was 10 years ago. Why? Because our currency is worth less. So even though you might be getting a raise of 5% or 3%, if the currency is being devalued by double that, are you actually receiving more token in terms of the preservation of that token for what you're exchanging your energy for? The answer is no. We've seen a massive divide over productivity and real wage growth. I'm talking real wage growth compared to inflation since the 1970s when we depegged. In fact, there's this massive separation happening. We've produced double what we did 50 years ago, but really, real wages haven't grown by much. So, in order to win this game that's rigged against us, we have to own assets and cling to those assets in order to preserve purchasing power. But the other question that we have is this going to continue? Well, I can fundamentally say, yes, it's going to continue. Why? Because we're in $38 trillion of debt. That represents 124% of GDP, which is the highest that we've seen since war times here in the 1940s, right? And as the government spends more than it collects, which it has to right now, because it's covering Medicare, Medicaid, Social Security, its interest on its national debt, what does it have to do? It has to issue more treasury bonds, and it prints money to buy those bonds. Essentially, it's printing money to go into debt because it can't afford what it's spending. Okay? That's like us taking out debt and then printing more money to pay off our debt. We can't do that, but the United States can. What that leads to is a dilution of the dollar. The more dollars that are in circulation, the dilution continues, right? Which is inflation. And it's inflation on not only expenses, but it's inflation on assets. Okay. And the world is looking at this and saying, what on earth is going on? But let's be honest, they're doing it too. But they now are starting to lose the faith of the United States financial system. We used to be a responsible place, which is why the dollar was pegged as the world reserve currency. But that's no longer happening. We're mismanaging our financial house, and foreign owned treasury securities are being dumped in record pace, and they're being diversified away from the US dollar and debt issue into assets like gold, commodities, other digital assets. And the dominance that we once had in terms of being that world reserve currency is now in serious jeopardy. So if we start to then get that thought in place, well, is this problem likely to continue? We have to be very intentional of how we are storing our energy tokens, right? We worked hard for our energy. Let's use an old analogy, right? Going back to old times, right? If we take a example as the show Alone, I don't know if you guys watch the show Alone. I do. It's on the History Channel and it's also on Netflix. These are 10 contestants that get put out into the wild, in the wilderness. They have 10 items that they can bring with them, such as a fire starter, fishing net, a knife, axe, a saw. And they use these items to capture food, water, and then also make a shelter. However, they're expending energy working for their shelter and for food. They're going out hunting. And some of these contestants are getting exhausted. And some of these contestants are winding up with great luck capturing fish, capturing food. But then the concern sits in on okay, well, it's going to get cold in a couple months. What am I going to do to preserve this energy for the future? And what they're deeply concerned about is the dilution of that energy, basically having that food spoil, having that food be stolen by other animals, right? So they're sitting there racking their brains over how they can preserve that. Okay. Same thing is going on in modern society. We're working, we're expending calories, we're expending energy, we're expending years of our life, and we're being basically given these tokens and we're saving these tokens so that we can use them in the future and retire. But what's going on behind the scenes is those tokens are being eroded from the inside out. So how can we win? Well, we've got a couple methods of storing this energy. The first is savings accounts. Arguably a pretty bad way to store your energy. It's super safe, it's FDIC insured, but it rarely beats inflation. In fact, purchasing power gets eroded over time in savings accounts. Next up, we have bonds. Bonds provide a predictable income source, generally higher interest than savings accounts. Treasuries are backed by the US government, but there's also some cons. Inflation erodes those returns, right? At best, you're likely keeping up with inflation in bonds, but at worst, in times when rising yields drive down bond prices, you can lose out to inflation. Now, the current setup for the next 12 months is likely net positive to bonds as interest rates are likely to be lowered. But after that happens, bonds are probably not sitting in the great place. The next runner up is gold. Gold is a old method of storing energy. It's been around since biblical times, right? It's scarce. It's desirable. Not sure why. It's a shiny metal, but it has been made desirable since thousands of years before now. So it is what it is. But it maintains purchasing power. It's independent of government printing, but it doesn't provide any income. It doesn't really do anything. It's cumbersome. It requires storage. It requires security, right? In vaults. It's slow to transfer. Try to transfer a few blocks of gold over to England. It'll take you a while. It'll cost a lot. So it's not necessarily the best, probably either, right? But it's what's been around for years and years and years. Moving over to the stock market. Stock market is a way to preserve purchasing power through owning or the ownership in productive businesses. These businesses generate revenue. These businesses are outpacing inflation. Generally, good ones are because they're taking all these dollars that are coming off of the central bank and they're creating profits with it. Therefore, their share prices are inflating because of it. But the worry is that their share prices are trading at what's called 23 times price to earnings. These are highly elevated valuations based on historical of 17. The question's still out. Is the stock market overvalued or is it actually fair valued given the backdrop of more money coming into the system and these companies likely picking up those in profits? It's hard to say. But what we can say is historically, this market is kind of at its top limit in terms of P ratios. These companies need to make a lot more money in the future, or likely those P ratios will probably come back to something more historically in line. That sets up the next asset, which is real estate. Real estate has predominantly been a great inflation hedge. It's scarce, it's tangible, it provides value in terms of rental income, but also it's subject to erosion. It's got a lot of maintenance costs. You got to put on new roofs, HVAC, you got to tend to the yard, right? You also got taxes you got to pay, insurance you got to pay. You're vulnerable to natural disasters. Just look at Florida, California, even North Carolina these days have been having issues. It's illiquid. It costs a lot of money to sell your home, right? Brokerage costs and commissions and fees, and it's slow. Your house might be on the market for a couple months, and then you got to go through settlement, right? It's not a quick method. So none of these are perfect, right? We're seeing holes in all of them. Cryptocurrency is kind of our most newest case for storing energy, and it's very interesting. I was once, reluctant to participate or even think about this as a real method of storage because my concern around it was it provided no real tangible or real intrinsic value. Doesn't create income, doesn't create profit. But what cryptocurrency does is it aims to solve the dilution of our dollar. Number one, uh, the main cryptocurrencies will have a fixed supply, a finite supply, such as 21 million coins or 100 billion coins. You got to look at each cryptocurrency to figure out what that hard limit is, but that's it. No new coins can be reissued. That kind of solves one of the problems in currency debasement, does it? Two, it takes the power out of the central bank and governments, and it decentralizes that into a third party network governed by a separate entity. And in a lot of cases, the users govern the network. Therefore, the rules cannot be changed. Um, Money can transfer freely and quickly and inexpensively across country lines, right? As opposed to our current system right now, which is exchange rates and losing money in brokerage costs. So it really does solve some of the big issues that we have. However, it has a lot of volatility associated with it. It's a very new system, and it requires a lot of understanding of that system. It's still the wild west, I guess you could say, in terms of this industry, but it's evolving, and with that some regulations are coming out, but we used to have very little regulations there. So this is kind of our last method of storing wealth, and really we've got to think about this in terms of an analogy I like to use is imagine there's this bucket of water, and this bucket of water represents the economy. Okay. And the water is actually currency. Okay. And inside that bucket are floats. And imagine these floats are assets, stocks, gold, cryptocurrency, real estate. And as this water is being dumped into this bucket, as more currency is being flooded into this bucket, what are the floats doing? Well, they're reacting to the actual event, which is more into this finite bucket, which is our economy. They're floating as a representation or a barometer as to all the currency and water that's coming into this bucket. So ask yourselves, are your assets going up in value? Is there that much more demand for your current home? Or is it simply a barometer to all the currency that's being flooded into our system? Right? That's a deep thought on what's happening, but it's really something you need to consider. So, as we end today's video, your job, as well as ours, being in financial planning and wealth management, is how do we store our hard earned money? How do we preserve all this energy that we spent decades of our lives acquiring so that it doesn't just get bled out to currency debasement, right? How do we preserve that for future generations, right? And really, in that quest, we're looking for, you know, assets that are scarce, that are easily transacted, indestructible, can't be duplicated out of thin air. These are the assets that are going to float, impenetrable, right? These assets, that's what you're looking for in terms of this economy, which is this bucket that are going to float. What are the assets that are going to float the most? That's what you're asking yourself. And the second question that you ask yourself is, do we expect this game to change? Do we expect that governments will just stop printing out money, especially if they have debt problems? Do we expect that the next big issue that we are not just going to print out a bunch of dollars to make that issue go away? Do we believe that corporations can grow their profits fast enough to justify these valuations? Maybe. More cash gets put out in the system. They sure have a way of being able to grab that cash and make profits and generate higher share prices. But at what level? Or is there a new sheriff in town? Or is there another more modern method of storing your energy better? You know, and really the last question that I leave you with is, how are you going to choose to tokenize your energy? Okay. Are you going to do it through uh, world currencies such as the US dollar? Are you going to diversify? In what form will your hard earned work endure over the next decades and generations to come for your children? This is what I leave you with today. And I'd really like you to think deeply. And when you do that, and if you have questions, we would love you to come back in and talk to us about it. You know, if you're a current client, please, circle back with us, request a meeting. If you're not a client, we have a QR code right here where you can register for a free consultation. And then more importantly, if you're not ready for a one-on-one meeting on Zoom, we can ask you just to subscribe to our channel and like this video. It helps more people get content that we put on our YouTube channel to them through the algorithm that Google provides. So thank you again for the time. Hope this gets you thinking deeper about your finances, and love to hear your thoughts on the topic today. Thank you.